Hi, I'm Luke Tait, here with Dave Young, and today we're going to talk a little bit about savers and what they can do in a market like today. So Dave, a lot of people are trying to save a little bit more money today. What's some of their options that they have?
Well, if you're just trying to save money conservatively, so like in money markets, CDs, that sort of thing, you don't have a lot of options. A few months ago, the Federal Reserve came out and said that they were going to hold interest rates artificially low for the next 2 years. And by doing that, essentially what that means is by them pushing rates down, it makes it so that on the short end of the scale, your savers are getting nothing in terms of return. I mean, I've never in my life seen rates this low and returns this low.
How is inflation affecting savers, and what is it doing in terms of their returns?
Well, as far as if you're investing in a CD or a money market, and you're getting somewhere between 0.5% and 1.5%, inflation and taxes are eating away at your return. So you're actually going backwards. I was actually curious. I pulled up the inflation rate for the last few years, and in 2008, the inflation rate for the year was 3.85%. Then it dropped to negative in 2009, negative 0.034%. Started creeping back up in 2010, 1.64%. And then ever since April, we've been at 3.16, then 3.57. In the last 2 months, 3.77 and 3.87. So essentially, you've got this inflation rate eating away at you at 3.5, approaching 4%. You're making 0.5% or 1%, and you're essentially going backward. Your money is becoming devalued.
So they're losing money.
They're losing money. Yeah, I mean, they feel safe, but they're losing money. And over time, if this continues on for a period of years, if inflation's at 3.5 to 4% over, say, a 4-year period, and they're getting their 1%, they've actually lost a significant amount of their money just by being there.
What's an option that Paragon offers?
Well, we've got our managed income account, and that's designed specifically for conservative investors. Now, you have to understand that in a money market or a CD, those would be a 1 on a risk scale of 10. So those are very conservative, very safe. You're not ever, unless the bank defaults, going to see your account go down. When you move over into something like what we've got, which is our managed income account, you're going to be taking on some market risk. We jump through all kinds of hoops, we do all kinds of things to mitigate that risk and reduce that risk, but still you have market risk. And so you've got to be aware of that.
So your money is basically not sitting there, but it's got opportunity to grow, but just like anything else, there's a little bit of a risk of a downside.
Right. No, there's definitely more risk than a money market or a CD. But that's the price that you pay to get the higher returns. Now, unlike just our growth account, where we're invested completely in the stock market and we're going right with the stock market, managed income, the risk level is not anywhere near that level. But still, there is some fluctuation, some risk. So if it's something that you're interested in, it's something that you could talk to us about to learn more about, to make sure you understand that risk. But I really believe that sitting in a savings account or a CD in these markets, you're not going to reach your goals. You're not going to make any progress.
So it's a viable option here in the markets today. How does it work? Like, what are some of the investments that are inside of the managed income?
In managed income, we're holding short-term, intermediate-term, and long-term bonds, corporate and government bonds. We're holding high-yield bonds. We can hold real estate, utilities, convertible stocks, preferred stocks, alternative funds. Essentially what we've done is we've taken all the conservative asset classes, or the asset classes that fluctuate less, and we're potentially including those in our managed income portfolio. Now, each one of those asset classes is either on a buy or a sell at any point in time. So we're only putting the ones that are on a buy in the portfolio. The ones that are on a sell we're out of. And that's how we reduce the risk and mitigate the risk, is by coming out of asset classes when they go to a sell signal.
Excellent. Well, thank you, Dave.
Thanks.
And thank you for watching Paragon TV.